Hi, and welcome back to yet another exciting episode in Robinhood School of Traders. In our professional journey, we all have come across the term called Six Sigma. In this episode, we'll try to resonate with this Six Sigma and how can we use the five principles, the five pillars of Six Sigma, and use that is to optimum effect in our share market. I'm sure together we'll enjoy this video, so let's get started. So, what is a Six Sigma? Six Sigma is nothing but a data-driven process. This was initially started in 1980s by a company called Motorola, and the main then taken care by then it was taken forward by GE in 1990s. The objective was very simple: enhancing business process and driving financial performance. This is what we want. So, if you resonate this our share market, we also want to enhance our process and driving financial goals, that is make maximize our profit. So to give a nutshell of the Six Sigma, the end result of Six Sigma is that if you implement Six Sigma, then your error will be minimized. Your error will be minimized in the tune to 3.4 defects on a production of 1 million. So that is the level which we are like asking. So on a production of 1 million, we are looking for a defect on 3.4 only. Just to give an overview or perspective of this, airlines have mastered this art. In airlines, I've been traveling for more than 15 years. I'm sure you, same with you also. So, in this 15 years journey, I never heard anyone shouting at the crowd or the airline staffs that I wanted to go from, for argument's sake, I wanted to go from Kolkata to Goa, but my baggage has went to Delhi. So that is not it. So that is this example, small example. Airlines and different production companies, manufacturing companies have done, and they have made a huge jump in profit in their bottom line. So Six Sigma has five pillars. We learn all the pillars and let us see how can we encash this in our share market. So the first pillar is a define. So we have to define and understand the stakeholders, the magnitude of the problem, and set very clear goals. So we have to find out what exactly are we looking at Six Sigma, and if you result in the share market, what exactly are our financial goals, and you have to make it very clear our objective and how to improve from there. Measure and collect data. So when we're doing a share market, we need to collect our data and performance. So we have to write down or jot down all our trades which have gone right or wrong also. Right trade, yes, we can write, but what went wrong also we want to keep in trade. So once we make in data, then from there we can take it forward. Analyze. So the third pillar, analyze. We have to find the root cause of the error. So in our terminology, the root cause what went wrong in our share market is, was it the timing, the data, our behavior, was it impulse buying, or it was sporadic buying, and did we miss the risk and reward ratio and all. So if you do this analyze our root cause, then we can come to a conclusion. We need to develop and implement a trading improvements. Obviously, we, as I keep on saying in my previous videos also, we need to develop and or modify our indicators. We need to add strategies also. So for different market, we'll have different strategies. For example, a rising market will have different indicators, the falling market will have different indicators, and the sideways market will also have different indicators. So none of the indicators, very few indicators, rather handful indicators there, they work very strong in all the three types of market: bull phase, bear phase, sideways market. And we have to monitor the process. Okay, this is what we do. Robinhood School of Traders. We try to teach the fundamental and technical so that you have a very strong command on the future, option, and crypto. So guys, we have started to trade crypto also. So the first pillar was share market is to define the problem. So we have to make very clear goal. What is our goal? So example, profit taking risk parameters. Example, for a swing trade, if you want to take a define a stop loss of 1% and profit of 4%, this is okay. For swing trade, suppose I want a profit of 1% and stop loss of 1%, this I think is not okay. So you have to make very clear cut definition of your parameters and risk parameters also. So what will happen if my script is in RCOM, and what happens to my script is an idea. What will happen to my script is a yes bank. So at end of the day you have to make a parameter, or rather this Six Sigma says before entering the trade you have to make a six absolute rule of my stop losses. Select the market segment. By the time I'm sure we all are expert, I'm a very strong player at mid cap market, mid cap stock, or Nifty 50 or Nifty 200, or I'm very good stock, very good trader at FNO or on option or commodity. So you have to make very clear statement to yourself then which segment you are very strong at. In terms of profit booking, if I say example, if I'm able to make 2% ROI on my capital, that is a humongous with a stop loss of 1%. So in this scenario also, I can make a maximum profit of 24% per annum. That's a humongous. And if my stop loss got triggered also, then I make a profit of 12%. That is fair enough than your FD and far better than few mutual funds. So these things you have to make very clear before entering the trade. Analyze your loss pattern and setup. This is very important. The root cause of a loss. Was the timing right? Was it a news-based trade which I have taken, or was it a false breakout? In timing, this is helping a lot. Initially I used to trade the pre-open market somewhere to 908 to 920, 925, and most of the time my stop loss gets to get triggered because that is the time the market is high volatile. Then I decided my strength is not that. My strength lies somewhere between 932, and so now when I take a trade, I generally take a trade somewhere between 930, 945, and in that trade also I don't enter a new trade somewhere between 11 a.m. to 12 a.m. So this is thing which I've learned for root cause analysis, and I generally don't trade news. If news is right and it has to be backed by volume, then I take a trade. Purely trading on news, I think will not give a strong result. Similar with false breakout, most of the indicators will give you wrong signal, a false breakout. So you have to understand which indicators work pretty good in false breakout. Once you have made this particular trade, then you can easily find out, identify high and low probability setups. So once you have done this little homework, this will help us in identifying which are my high probable trade setups and which are my low probable trade setups. The next pillar is say improving the trading process, adjusting the position size. Example, right now the market has giving no direction. So example, I have 100 units to be put. Should I put in one shot or should I put in staggered way? That is 30, 40, 40, 30 or 50-50. So that's up to you. That's up to your appetite and that's up to your risk management. Eliminate low probability trades. So if example, I basically go over 2 or 3 indicators. If as one of the indicators is saying a buy, another indicator is saying nothing. So this high probability, I will not take the trade. Optimize entry and exit. This is a very strong strategy. We have a tendency to book our optimum losses, but we don't enjoy the entire rally. So if your trade is doing good, we'll let the trade to run to have the maximum profit. So you have to define the specific strategy for exit also, as we define exit strategy for entry. This is a very important. As I told you, we have to make our trade journal. So anything which is data which you have is not only the profit statement, it is the trade journal. Which indicators are used, what is the time at the entry, what was the psychology, what was the market, what was the Nifty behaving like, and what was the news in terms of the quarterly result or what, and what was the price action. So this, if you're able to make a simple trade journal, this I think will help you in getting your trading to next level. Checklist of consistent execution. So once you have done this basic homework, and if you just look at your winning trades, if you just observe winning trades, most of the time the winning trades you must have done right. You have entered the right time, you have entered as per indicator, you have entered as per volume, or you have entered as per what strategy of design. And for most of the wrong trade, you will find that you have gone against the trade rule which you have made. So this is the Bible for me. Once you are doing a trade, you have to do a trade journal. What is a trade journal, Robin? Just write it down and jotting it down in a proper format, Excel, diary, or paper, and have a look at that. So that will be keeping an yardstick for a data centric. So that will give you more data to take it forward. Emotional and impulsive, this is very easy to say but very hard to implement. Is it emotional buying or impulsive buying? These two are very contradictory sectors. So your, as per this Six Sigma says, you have to eradicate these two pillars, emotions and impulse, and you have to buy the stock based on data driven and process driven. So once your data and process are in places as per we learned in Six Sigma, this will help you to yield you more profit rather than sporadic buying. Risk control, yes, it's our hard-earned money. We can't let our money to go. So one has to be very clear about the risk control. You have once entering before entering the trade, you have to make it very clear what is my risk appetite and what is the profit I'm going to take. Guys, I'm sure you must have enjoyed the video. If you enjoyed the video, do subscribe to my channel and hit the bell icon so whatever video I'm creating comes to you directly. And if you have any question or any query, do write to me, or you can call me on this particular number. It will be a privilege to serve you. So that's all about a very small, brief video on Six Sigma. I'm sure you must have enjoyed it. Thank you.